this Friday edition of Inside India. I'm Sri Jegarajah. Let's get you across today's headlines. President Trump escalates his trade war, setting 35% tariffs on Canada. And he tells NBC News he's planning blanket 15 to 20% tariffs on most other trading partners. All eyes on TCS as India's top IT services provider posted a revenue miss. Tariff uncertainty keeping clients on the sidelines. We will be hearing from TCS CEO about those results just ahead. And Tesla is set to pull up in India next week with its first showroom in Mumbai on July the 15th after a years-long wait. Right, as the case has been for quite some time, a lot of ducking and diving in the Asian markets given the latest tariff salvos that's being fired by President Trump's administration, this time facing Canada. We mentioned that in the headlines, but as of now, the market's doing a reasonable job in taking all of this in their stride. However, so a mixed picture for APAC right now. However, US futures and European opening calls are telling us a more negative, bleaker story. So perhaps we might see those headwinds really transpire in the early part of next week's trading action. Trump's tariff notices still in focus. US President telling Ottawa that he'll impose tariffs of 35% on Canadian imports starting August the 1st, sending the dollar higher against the Canadian loonie in early Asian trade. US dollar is also strengthening across other majors. Still early, but US futures, as we noted, are trading lower. In a phone interview with NBC's Kristen Welker, Trump also said that countries that don't get a letter could get a blanket tariff of either 15 or 20%. Blanket tariffs are currently set at 10%. In the meantime, India's negotiators will reportedly head back to Washington soon to push forward the so-called mini-trade deal after earlier reports suggested an announcement could come this week. Delegation is also expected to seek clarity on President Trump's latest move, including the proposal of imposing 10% tariffs on BRICS countries. Indian markets join us in about 45 minutes' time. Here's what Gift Nifty futures are indicating for the benchmark and the early action. We're looking at a start in the region of about 25,300, so that would represent something of a slide. Nothing disastrous, though. Dollar-rupee exchange rate, 85.753. Nifty will also be reacting to Q1 report numbers from Tata Consultancy Services. This is India's largest IT services player, of course, flagging uncertain environment due to tariffs. We will be speaking to the CEO and MD of TCS shortly. In the meantime, JP Morgan may cut the weight of big issuers like India and China in its flagship emerging market bond index. Bloomberg is reporting that the bank is considering a plan to lower the cap for any single country from 10% to 8.5%, a move that would shift weight to smaller markets with higher yields. Any reduction could impact global inflows into Indian currency bonds, which were added to the index just last year. Changes are still at a consultation stage with no final decision yet. And trading volumes are thin in the country's options market after the market regulator SEBI banned US trading firm Jane Street and froze over $566 million. It's expected to bounce back, though, as larger investors come in, but the regulator is more concerned about retail investors burning their fingers in the derivatives market. Individual investors lost over $12 billion trading options in the last financial year. Strong retail participation is also driving mutual fund flows into India. Last month, equity mutual fund inflows rose 24% to $2.75 billion, snapping a 5-month contraction. Let's get more on these markets and all of these moving parts and bring in Nilesh Shah now, Managing Director at Kotak AMC. Nilesh, great to have you on the programme. First of all, how would you describe sentiment and confidence levels generally among retail investors, and how are they positioned this fiscal second quarter?
The retail investors continue to believe in long-term India growth story, but at the same time, they have been following a pattern where in a rising market, they normally do regular investment, what we call SIP, and then they put some redemptions, they do some profit booking. In a falling market, they have been doing the regular investment, but also give some lump sum investment. So buy low, sell high is what Indian retail investors are following.
Let's bring in SEBI versus Jane Street, Nilesh, and the market implications there. It's already, as we noted earlier in our introduction, hitting options volumes and quite possibly NSE's pre-IPO valuation. Were the retail crowd overexposed to this part of the market, to the derivatives market to begin with? Is that part of the problem? And has this shakeout run its course, or are there more skeletons that will fall out of the closet?
So undoubtedly, retail investors have been trading options significantly. Almost 80% of number of contract on options worldwide are traded in India. And one side of that option contract is represented by retail speculators. SEBI has been warning them that 9 out of 10 people continue to lose money. And yet 10 out of 10 believes that they belong to 1 out of 10 category. Let the law takes its own course. SEBI has issued a detailed order. Jane Street has given its denial. I think ultimately the courts are the best authority to decide whether there was anything wrong or not.
So, Nilesh, walk us through the reforms you believe SEBI needs to enact to ensure that India and the market doesn't become, in your words, a playground for manipulative merchants.
So essentially, SEBI has done a great job in improving governance, building infrastructure. Today, we have the largest volume in the world. But at the end of the day, the world keeps moving forward and SEBI has to catch up, or SEBI has to move ahead. Couple of things which should be focused by SEBI is related to insider trading. Unfortunately, they don't have wiretapping power like US regulator. I'm sure at some point of time, they will get appropriate power to control the menace of insider trading. The second is to encourage innovation. Today, Indian retail investors jump from fixed income into equity. There's not a big asset class on hybrid side. If we can splice risk, maybe more investors will get attracted to the market. So encouraging financial innovation and ensuring that insider trading, front-running kind of menaces are stopped will be continuing SEBI's good work.
Nilesh, let's park that conversation on derivatives and the risks there for now and move on to earnings. And what is your sense amongst how the retail investors are feeling about quarter-on-quarter earnings? They're not quite hitting the mark, are they? And IT services and TCS was a case in point. Is that why we are seeing something of a re-rating in the market?
So most retail investors won't bother about earnings in an aggregate. They'll be driven more by individual stock earnings. And undoubtedly, after double-digit growth for last year, last 4 quarters earnings growth on Nifty 50 companies is in single digit, mid-single digit to be precise. We believe this is the time where growth will get consolidated and we will see uptick in earning more likely to come in FY27 rather than FY26. Of course, small and mid caps can continue to have higher earnings growth, but do remember that they trade at much higher valuation. So we are likely to see consolidation in earnings towards mid-single digit to high single digit, and double-digit earnings growth is more likely FY21 story than rest of the 3 quarters.
So from a sector allocation point of view, Nilesh, we need to have faith in the long-term narrative for India and the macro backdrop. So we express that, do we, in terms of banks, financials, insurance and the FMCG sectors? Is that where retail investors need to be positioned?
So on the consumer side, it's not consumer staple, but consumer discretionary. There is about $15 billion worth of tax rebate given by the government in the budget. It's recurring every year. EMI burden has come down on Indians who have borrowed auto loans, housing loans, personal loans. That's roughly about $15 to $20 billion savings. There is 8th pay commission recommendations coming into play from CY 2027 beginning. Put together, more money is likely to be in the pockets of Indian consumers, and they are more likely to spend it on consumer durables and consumer discretionary rather than consumer staple. So along with banking and financial services, I'll recommend consumer durables and consumer discretionary.
Understood. Nilesh, and just moving on to the external side of the equation and the risks associated with tariffs and the US market, we got a glimpse of that, didn't we, with TCS numbers and the revenue shortfall. How cautious are you and how cautious should retail investors be towards IT services? Or are there selective opportunities in the names that are best positioned to ride out this current cycle of uncertainty?
So undoubtedly, tariffs will be a major policy announcement. And there are sectors like IT services, pharma, some of the engineering exports, which are dependent upon US. US is a large market for them. These are the sectors where one will have to be careful. We really don't know how to predict tariff imposition. The rates and the back and forth continues to hamper our ability to forecast anything meaningful. In our portfolios, what we are doing is that instead of reacting to the noise, we are reacting to the news. Let the tariff come out and then we will reassess what will be impact on our portfolio.
And finally, you touched on pharmaceuticals there, Nilesh, and are pharmaceutical exports in jeopardy if President Trump has just announced 200% tariffs? And how are Indian pharma stocks going to price this? It feels like Dr. Reddy's is the most exposed. Again, how selective do we have to be? What's your advice?
So undoubtedly, we'll have to see what the tariff policy is. But do remember that 40% of American generic medicine consumption is provided by Indian pharma companies. And despite that, they just take 10% of their medical healthcare spending. So Indians are providing quality, cheap medicines to America. If you impose high tariff on it, availability of medicine could come under pressure. Second, the distribution in America is almost oligopolistic. 3 or 4 players control distribution, and they have disproportionately higher margin. I'm sure there will be equitable burden of distribution between manufacturers who make far less margin and distributors who make far more margin. So as I mentioned, we'll react to the news rather than the noise.
Nilesh, and very finally, as far as the external picture is concerned, how closely are retail investors watching the developments surrounding the US-India trade deal? The expectation is that we will see a short-term early harvest mini deal, depending on how you characterize it, collectively taken with the UK-India deal, EU-India trade deal. What is that worth for the market?
So essentially, retail investors are hopeful that the world will do a fair deal with India. We run second largest deficit after America in the world on the goods side. And the expectation is that as the world tries to de-risk itself from China concentration risk, India can provide a good alternate. And this tariff deals, the free trade agreement deals, will probably reflect the same. So in some sense, markets are complacent about tariff. They believe there will be no adverse impact. Anything contrary to that will create correction in the market.
We'll leave it there, sir. Always great catching up with you and hearing your thoughts. Nilesh, we appreciate it. Nilesh Shah there from Kotak AMC. Thank you. And do read more about India's options market facing a reality check in this week's Inside India newsletter and become a subscriber for more stories shaping the country's markets and economies. Scan the QR code on your screen to get started. Coming up in the programme next, India's largest IT firm, Tata Consultancy Services. We just touched on this with Nilesh. Flags weak macro conditions. We'll be speaking to the CEO and MD of TCS after the break. Don't miss that exclusive conversation coming up next. Welcome back. India's top IT exporter, Tata Consultancy Services, missing quarterly revenue estimates. TCS reported a 1.3% rise in sales to $7.4 billion, coming in below expectations as order bookings dropped sharply from the prior quarter. Clients of the IT services giant remain cautious, and discretionary spending is still delayed, with no clear signal yet on when growth will pick up. TCS flagging tariff-related uncertainties, raising concerns for India's $283 billion tech sector. Let's get into this, and I'm delighted to say K. Krithivasan is joining us now, CEO and Managing Director at TCS. Sir, thank you very much indeed for your time. First of all, your reaction to this revenue shortfall.
Sri, like you said, while we started the quarter, or towards the end of last quarter itself, we flagged the increasing uncertainty because of the trade discussions. And what we saw during the quarter, primarily it lingered on or sometimes even intensified. And some sectors were even more impacted. For instance, you take the consumer business, there was a bigger impact. Or there was a sectors like auto, we had bigger impact because of these trade discussions and related supply chain disruptions. Some sectors did well, but overall, I would say that the uncertainty, because of that, we had some project delays, some projects were de-scoped, resulting in lesser overall revenue booking this quarter.
Understood. What are the leading indicators then telling you about revenue prospects in fiscal second quarter and beyond?
Actually, it will be difficult to comment on next quarter for us. But I've been calling out even before. If you take medium to long term, there are 2 or 3 major indicators for me. One is our own order book, which is quite healthy. The second is a discussion that we've been having with our customers, which point out to their interest in restarting discretionary program once there is a clarity on what would be the impact of tariff or other geopolitical uncertainties they may face. The third is from a technology's perspective, where we believe there is so much of technology backlog many of the firms are carrying, and with particularly AI, Gen AI coming in, the amount of new modernization they have to go through. So these 3 together, to me, medium to long term still looks good, but difficult to call on the immediate term.
Understood. Can you elaborate on what you just said, sir? And what exactly are the positive catalysts that you perhaps can identify that could lead to improved client confidence and stronger revenue and performance in the future?
See, one could be like if the trade deal with China is closed, okay, so which gives confidence to all the retailers in US. It means that and also some certain of kind of certainty and then resultant growth.
And turning to India, what would a short-term or early harvest US-India trade deal mean for TCS in revenue terms?
Directly, companies like TCS, we have less of a direct exposure to the tariff discussion. Ours is primarily more based on indirect or derivative impact. And at this time, services is not directly under the purview of the trade discussions. So we don't expect one way or other. For us, the primary impact will come from overall consumer confidence being up in US and similar, and the investor sentiment turning positive. Direct trade between US and India may have less of an impact.
So it's really macroeconomic conditions driven by more certainty in the tariff narrative. So from the US market perspective, and let's just circle back there, have we seen the worst of the DOGE cuts on federal government contracts, and is that still impacting orders for TCS?
See, our exposure to federal government contracts very, very minuscule. We have, I don't know, we may be having less than a few tens of millions of revenue coming from federal contracts. So our exposure is limited. So it will be very difficult for me to comment whether the worst is over.
I understand. And turning to India, can you clarify what's happening with the BSNL network infrastructure project? We hear that it's ramping down and nearing completion. To what extent was this a factor weighing on the quarterly performance?
Purely on a number perspective, on a quarter-on-quarter basis, it had we had reported a minus 3.3% of negative growth. Out of that, almost 2.8% came from BSNL project winding down. It's a happy situation in the sense that we completed the program. It's a very ambitious program. So excepting few sites that are not ready to be implemented, we have implemented the whole software in almost 90% of, more than 95% of the towers. So that's why it's winding down. And we are also expecting the next tranche of order, we have an advanced purchase order for that. We are expecting a final purchase order to start the work. So I'm hoping that it can start in this quarter sometime and give us some revenue uplift.
How are you managing the currency market volatility?
We have a very good hedging program, but at the same time, our hedging program has a very modest objective. Our objective is to protect our revenue. We don't play in the market to increase our revenue. So we have a hedging program that, all these days, what is happening is US and Indian rupee, it was always range bound. But now we find that it is more volatile. So we will start hedging for the US dollar also. But all these days, we've been having a very disciplined hedging program on euro and GBP. Probably will start some hedging on dollar, but all these days dollar rupee was in a strict narrow range.
Does this uncertain global economic environment mean that TCS has to embark on a belt tightening program, or are you continuing to spend through this cycle?
No, more than belt tightening, Sri, what I find is these new technologies like AI, Gen AI can get us more productivity out of the same same set of people we have. So we want to ensure that our clients get the benefit out of this productivity improvement. So I won't call it a belt tightening, but at the same time, I want to drive productivity so that the benefit and gains could be shared by TCS as well as our customers.
So that's interesting. So on the headcount side, does the AI push and AI transformation part of the business mean you need to potentially hire more specialist AI talent?
Yes, we would continue to hire more on high-end talent. We look for more high-end talent in the AI, Gen AI. And in fact, because AI, Gen AI also spins interesting work in data, cloud, every other area. So we would be looking to hire more high-end talents, definitely.
So ultimately, Mr. Krithivasan, is AI spending the saving grace for TCS? Is that part of the business intact and growing? And could these earnings have looked a lot worse if it wasn't for the AI boom? Or is even that strong demand center going to come under some stress?
See, you have to understand, Sri, AI, while all of us keep talking about revenue coming through AI has become all pervasive. It is not restricted to one specific technology or one specific domain. Even when you do data migration, you use AI. When you do application maintenance, you use AI. So there is a AI-driven revenue in terms of new business use cases that we implement. But AI is also present in every part of other work we do. And definitely AI is helping in winning new deals with our customers, showcasing better productivity, thereby gaining more market share. Is AI a new saving grace? Yes, because it helps us in taking new solutions to our customers. It is not only because of AI. Otherwise, the pure AI revenue is not a very material part of the overall 30 billion. It may be a sub-billion for us. So I won't call it a saving grace, but it's an important technology innovation that helps us get better productivity to our customers.
So it feels like cybersecurity issues are the Achilles heel of this AI boom. And TCS has been the IT services provider for the British retail giant Marks & Spencer for quite some time. M&S was hit by a major cyber attack in April, I believe. TCS conducted an internal investigation. Can you share with us what your findings were and what assurances and guarantees you can give your clients about the integrity of your services?
See, 2-3 points like that. I'm seeing the line running in your show. First of all, M&S is continuing their investigation and they want to understand what happened. We don't want to comment on it. But particularly to what we can comment is TCS infrastructure was not impacted. Our systems are not impacted. So there is no risk to any of our other customers. Third, we can confirm that our associates followed the standard operating process. And fourth is we are not directly under investigation on this one. And as you probably would have heard through other sources, it is more than a technology attack, it's a social engineering attack, which tells us that we have to be extra careful, extra vigilant in updating our operating processes and then creating greater awareness amongst our associates.
Point well taken, sir. Thank you very much indeed for joining me on Inside India. Mr. Krithivasan, K. Krithivasan there from TCS. We're back in 2 minutes. Welcome back. Let's take a look at the energy complex and the two global indicators, benchmarks for the oil market. WTI 66.92, Brent crude 68.93. OPEC saying global energy demand will rise 23% by the year 2050, and India will be a key driver in its latest World Oil Outlook report. The group projects global primary energy demand to hit 378 million barrels of oil a day by the year 2050, up from 308 million this year. India alone is set to add over 8 million barrels of daily oil demand. That's the biggest incremental growth among developing regions. That's due to the rising population and a surging working age demographic in the country, even as consumption in developed economies holds flat or declines. But India primarily relies on imports to fuel this surging demand, with nearly 40% of it coming from Russia. US Senator Lindsey Graham says the Senate is moving ahead with a Russian sanctions bill. CNBC's Dan Murphy spoke to OPEC Secretary General about this and the overall demand outlook.
We see strong global economic growth. In our forecast, we read this year's growth at 2.9% still. And I always say we have to differentiate between the noise versus the facts on the ground. The facts on the ground for us is what matters. We see strong demand in the Middle East, in China, aviation sector booming, in India and many places of the world.
One of the other key concerns in the market right now is the fact that the US president is also threatening sanctions on the top buyers of oil, including China and India, for purchasing oil from Russia. What's your reaction to that?
Well, I mean, Russia is a global provider of energy to the world, not just oil. I mean, 10% of global oil supplies come from Russia. It's important to have uninterrupted supplies, again, from all sources of energy to the world, whether it's oil or gas. I think it's important also to remember that demand is growing, as we have shown, and therefore this smooth flow, uninterrupted flow of supplies from the world has to continue.
How concerned are you about those potential US sanctions, though, particularly on top buyers like China and India? These are key demand drivers into the future. What happens if the US moves ahead with that type of plan?
Well, there's a lot of talk happening, but we don't usually comment on specific sanctions or on specific political events. I think for us the most important thing is OPEC's message, is that really the world must continue to receive what it requires in terms of supplies of oil, of course gas and energy.
In the meantime, Tesla is set to make its Indian debut with its first experience centre. The EV maker opens the doors of its Mumbai showroom next Tuesday. The 4,000 square foot facility will sell cars directly to consumers, with local partners handling after-sales support. Tesla will offer made-in-China EVs in India, with the Model Y expected to start at over $56,000. After the Mumbai launch, Tesla is eyeing the Indian capital for its second facility in the country. We are counting down to the market open in India. This is how we are shaping up. Let's give you futures just under a quarter of an hour away from the official market opened, 25,297. So we are looking at a wee bit of give back for the benchmark Nifty 50, which closed yesterday at 25,355. Let's give you the dollar-rupee exchange rate while we are at it, sitting at 85.814. All eyes will be on IT stocks when the markets start running. Take a look at US-listed shares of Infosys and Wipro, both falling more than 3%, signalling pressure ahead after peer TCS kicked off earnings season with a revenue miss. The weak TCS numbers underscore uncertainty in India's tech sector. Next up is HCL Tech, which reports on Monday, but tariffs could dampen what's otherwise expected to be a steady quarter. Let's do a deeper read on what to expect from the IT services sector this earnings season. Bring in Sumit Jain, Senior Research Analyst at CLSA. Sumit, great to have you on the programme. Your take, first of all, on TCS's revenue shortfall, and is client caution and a slowdown in orders going to be the common strand running through the IT services this quarter?
Yeah, no, thanks for having me. I guess, if you look at TCS results, obviously, on the top line front, it was slightly weaker than what consensus was building, but it was largely in line with what expectation we had, where, BSNL was expected to have a sharp ramp down, which is what happened. But in the rest of the international market, the growth was around minus 0.5%, which I believe was somewhat factored in by the majority of the analyst community. I think the biggest negative surprise to us was, one is the demand commentary in the banking financial services space slightly deteriorating. And mind you, that is the biggest vertical for TCS and most of the Indian IT companies. Yes. And that has been recovering for the last 1 year. I think TCS specific challenge was the overcapacity they faced in the quarter, where they also paid a quarterly variable allowance to keep their employees motivated in a quarter where typically wage hikes happen every year, but that was not the case this time around. So I guess margin pressure to us because of TCS specific challenges was a bigger concern. I think the broader read-through for the rest of the sector you asked, I believe HCL will throw us a better light as to the weakness, what we are seeing in BFSI. Is that percolating down to other companies as well? It could be a TCS specific challenge in my view, because they also mentioned that there was a particular client in Europe where there was certain project completion. So I think it's a very interesting time for IT sector, I believe.
So from a verticals point of view, Krithivasan was telling me that it's consumer autos that were really at the sharp end of the slowdown in discretionary spending and exposure to the US market. Is this just a TCS-specific story, or who else has exposure to IT services in the US market and therefore can only really stage a meaningful turnaround once all this economic pessimism and the tariff-related uncertainty recedes?
Yeah, no, I think, see, for the consumer and auto manufacturing, I think that's a pressure which everybody has been facing now for the last 9 months. And in the last 3 to 5 months, that got further accelerated because of the tariff related uncertainty. And I believe that is not going to go away in the near future. And that is something which all Indian IT companies will get impacted. And just to highlight, retail, consumer sector is the largest after BFSI, and even auto manufacturing has low to mid single digit exposure for everyone. So that is going to impact everyone. But just to highlight, in US markets, the airline company Delta gave a very positive outlook for the rest of the year, where consumer sentiments have actually been improving. So probably the tariff-related uncertainty is going away in the mind of consumers, where as per University of Michigan Consumer Sentiment Index, there was a sharp jump from 52 in May to now 60 in June. So yeah, it seems like the consumer sentiment is improving, which potentially should reflect the lag in these sectors in a positive way.
Sumit, when you look across your coverage area at IT services, listed IT services in India, who then is best positioned, least exposed to the most vulnerable markets like the US and most diversified, perhaps, to ride out this cycle?
So yeah, I think among the large cap companies, I would say HCL is slightly more diversified across manufacturing, consumer, BFSI, and then I guess their exposure is also more towards cost optimization, vendor consolidation deals, which is the flavor currently for the market. But yeah, I think in the mid cap space, you have companies like Coforge or Emphasis. Emphasis is rather more BFSI oriented, but Coforge is definitely more diversified across BFSI, travel, transport, hospitality. So yeah, I think TCS and Infosys are more BFSI and US exposed, but then you have other names which are much more diversified, and that's where we got a better growth guidance from HCL for this year compared to Infosys.
Understood. That said, Infosys has been responding with job cuts. Does this uncertain global environment, Sumit, mean perhaps more belt tightening, job cuts, a hiring freeze, cost discipline, or do you think that these players are able to ride out the cycle?
Yeah, no, so we believe that the IT services spend, particularly on digital transformation, have been quite muted for the last 3 years. And in the last 3 to 4 years, if you see the corporate tech spending, that has been largely on chips, on cloud, as well as on software and SaaS, probably at the expense of IT services. Now, with the recovery in BFSI, which started to happen last year, and with the potential interest rate cut, it was expected the recovery will happen in the rest of the sectors as well. And as far as the jobs are concerned, I mean, the TCS result was a clear reflection that Gen AI is not bringing in a huge non-linearity for IT service companies at least. Although it is bringing that non-linearity between revenue growth and headcount growth for the platform-based companies in the US, where we have seen a lot of layoffs, but not so much in Indian IT, where I believe given the fragmented market share structure of the IT service companies globally, the sector globally, the non-linearity between the two will never kick in. So the revenue growth should lead to headcount growth. So not so much bearish, I would say, on the headcount growth perspective for the Indian IT company.
So let's talk about that AI boom. And could these earnings, we've heard from TCS, could they have looked a lot worse if it wasn't for the AI spending that still seems to be relatively resilient despite the fall off in enterprise? Or is even that mighty center of demand going to come under some stress?
No, clearly, I think AI is a start of a new technology cycle where, as far as the IT consultants like TCS and Infosys are concerned, it's a new technology to upsell, cross-sell to their existing clients as well as new set of customers. And mind you, when you talk about Gen AI solutions, it involves a lot of underlying work around data, around cloud, around cybersecurity. So it is around companies which do not have their data structures in a proper format, it's an added opportunity for IT service companies and consultants to guide them through. So whatever strong spending you have seen for NVIDIA, the chip stocks, as well as for the cloud hyperscalers in the last 2, 3 years, we believe that opportunity will start shifting to IT service companies as macro improves going forward,
Yes.
where IT service companies will be the key plumbers to stitch the complex tech ecosystem.
We heard Mr. Krithivasan talk about BSNL and arguably how that halo effect and the ramp down was to blame for the earnings, for the slowdown, for the shortfall in revenue. What then is deal flow looking like in the fiscal second quarter and beyond and into 2026?
See, I mean, deal flow, at least for this quarter, was pretty robust for TCS. They had a 13% YOY growth, and it is in the range of that $8 to $10 billion, which is pretty comfortable for them. And that, if you remember, when Accenture reported their results in June, there were a lot of concern that the order booking has slowed down for the entire sector. Whereas I think investors ignored the point that the large order books can be lumpy, and the timing of the signing can have a huge impact on the YOY growth curves. So we believe that, based on the management commentary and what we are seeing the overall technology demand cycle, the order booking should be robust in the coming quarters as well, even for FY26. And another thing to quote there is, if you look at the order booking by software companies like Oracle or SAP, they have been pretty robust. And you need system integrators to weave those solutions into the client's IT architecture. So I believe, the order booking should be really strong. The point is the conversion of order book to revenues. If macro continues to deteriorate because of tariffs or the uncertainty, you may see them getting pushed out.
Yes. What then, Sumit, are the positive catalysts on the horizon for the IT services sector? Is it going to come in the form of a macro recovery? Is it going to come in the form of trade deals, possibly an early harvest US-India trade deal? Or what is it going to be that's going to lift the spirits?
Well, I guess so. Clarity on tariffs is obviously a key thing to watch out for. Maybe I think US-India trade deal will not have a huge impact for IT services sector per se, because majority of their clients are based in US, Europe. But yeah, I think to your point, clarity on tariffs will ensure that their clients will have a better view of the world. What kind of profitability are they going to achieve, and how much can they spend on IT services? So I believe this tariff-related uncertainty should go away in some time, and that's where the pent-up demand around digital transformation solutions or discretionary demand should come back. And that's where, we have maintained the stance of a V-shaped recovery for the sector in FY27 or CY26, where we are expecting a high single-digit growth for the sector compared to low to mid-single-digit growth for the last 3 years now.
Sumit, we'll leave it there, sir. Thank you very much indeed for joining me on Inside India with those insights on the outlook for India's IT services sector. Sumit Jain there, CLSA. Indian markets have joined the trading day. We'll look at the top movers shaping trade in Mumbai after the short break. We're back in 2 minutes. Welcome back. Let's give you the state of play in the Indian markets, and the benchmark Nifty 50 at 25,000, just under 25,300. It's off just by a fractional 0.3%. Indian rupee is looking like this against the US dollar, 85,783. So we are looking at a slightly softer Indian rupee. Shares of TCS getting a chance to react to Q1 earnings. Other IT companies listed in Mumbai are broadly negative, with the sole exception of Hexaware Tech, which is eking out very, very modest at that 0.2% gain. TCS down by almost 2%. Infosys and Wipro are next on bat, as is HCL, and all of them are down quite sharply, led lower by Infosys, down by 2.3%. We'll be watching for HCL Tech's numbers. As I said, due next Monday, it could offer more insight into the outlook for India's tech sector. In the pharmaceutical space, Glenmark Pharmaceuticals' innovation arm has signed an exclusive licensing agreement with US pharmaceutical firm AbbVie, giving AbbVie the exclusive rights to develop, manufacture and commercialise IGI's cancer treatment product. It would sell IGI receiving, let me rephrase that. It would see IGI receiving an upfront payment of $700 million and earning up to $1.23 billion in additional milestone payments. The deal is subject to regulatory approvals. Automaker Mahindra & Mahindra is reportedly eyeing local magnet production in a bid to reduce its reliance on China. China, which produces around 90% of the world's rare earth magnets, had placed restrictions on its exports earlier this year, rattling automakers around the world. According to sources, Mahindra is said to be open to partnerships to make magnets or enter a long-term contract with a local supplier. Mahindra has declined to comment. Right, let's pivot to travel now, and more people are skipping trips to the United States as June data shows a 3.4% drop in visitor arrivals. CNBC's travel editor Monica Petrelli is here with more on this story. Monica.
Yeah, good morning. Yeah, so some people might hear, well, a drop of 3%, not too bad. It could be worse. And of course, that's true. However, it's not just that we're seeing arrivals go down from last year. It's that these are down from the expected growth. Now, to put this into perspective, last June, arrivals to the U.S. were up 13%. And ending the year for 2024, arrivals were up about 9%. Now we see them dipping into negative territory. Now we see no country responding more in terms of postponing trips or canceling them altogether than Canada. But we're also seeing this from Western Europe, also even South Korea. Now, as I was going through all this data, it got me thinking, I wonder how Southeast Asians are responding. How are they feeling about traveling to the U.S. these days? So CNBC Travel commissioned a survey to find out. Take a listen.
For summer travel, the U.S. has got it all. Beaches, mountains, cities, and countryside. But this year, it's also got tariffs, stricter border policies, and an America First agenda that's prompting some travelers to holiday elsewhere.
We're the biggest carrier that flies into the United States. We fly to over 50 cities within the United States. Our traffic, our bookings, going over the next 6 months are down. We're down about 10%. Canadians are deciding to travel within domestic Canada or potentially to Europe.
Here in Southeast Asia, costs are normally the top consideration when booking trips. However, when it comes to the U.S., travelers have different concerns.
A new CNBC survey of 6,000 travelers shows worries about discrimination, actions by the Trump administration, and gun violence are top factors impacting interest in visiting the United States. These concerns, though, are not enough to stop all travelers, particularly those from Vietnam and the Philippines, from heading stateside.
It could be many reasons. One of it could be, because of diaspora ties with the U.S. So it could be because of family connections who live there. Besides that, there's the aspirational factor and the soft power of U.S. culture, through movies and through, TV shows. That still is very attractive.
However, not all travelers are pushing their concerns to the side. In Singapore, more than half of those surveyed said they're less interested in going to the U.S. now than they were 6 months ago.
I wouldn't say I will be particularly keen, especially with all the news and everything that's been going on.
The situation is not stable to me, so I'm probably not considering to travel to US within this next 6 months.
My perception of the US has changed over time, but specifically over the last 6 months, I feel that it's become more of an unsafe place. Yeah, because of my racial status, and as well as I think generally drugs, and it seems quite unsettled. I would be worried whether I'll be detained.
This effect may only make a slight impact on the overall U.S. economy. In 2023, Asia Pacific made up nearly 40% of foreign personal travel spend in the U.S., making it by far the largest spending group. But even if foreign travel were to drop 10% this year, JP Morgan analysts say it would only take 0.1% off GDP growth. Still, that could mean billions flowing into other key travel markets, like other parts of Asia, Europe, Australia, and New Zealand. And there's no doubt that these other countries will gladly take the tourist dollars the U.S. isn't able to hang on to.
Now, in terms of Indian travelers, we also saw a drop-off earlier this year, although nothing along the likes of what we saw from Canada or even China or South Korea. However, that really leveling off in the past 3 months. In the past quarter, we've seen arrivals from India to the United States, not fewer than last year, but also not more.
What's the perception amongst Indian travelers? Because one of the most wonderful things that I witnessed when I went to the West Coast, where I have family, is the non-resident Indians who work in Silicon Valley. Their parents come over to see them, to see their grandkids. I wonder if that flow has been affected by perceptions that you talked about in this article. And on the flip side, Modi and Trump have a great relationship. So I'm wondering if that is colouring people's perceptions too.
It seems that perceptions are still quite positive. So in a report that we published that has more of the findings from our survey, we also put some data in for social media listening. These are companies that can comb through social media to really kind of get the zeitgeist of what people are talking about. For India, in terms of people talking about traveling to the U.S., 96% of the engagement and the posts were positive. You contrast that, say, with the UK, which was evenly split, or Canada, about 55% was positive, probably mostly owing to how polite Canadians are known to be. Interestingly, the country that had the most negative things to say about travel to the United States were coming from social media accounts in the United States itself. So very different perceptions going on around the world right now.
Very interesting findings. I do commend you to read Monica's piece on CNBC.com. Monica, thank you very much indeed for that. Right, that's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East. Have a great weekend when it does swing by.